Strong morning for the market, and actually one sector that's doing really well today is cement. That is also the sector that we are now focusing on. What are the triggers at the end of the third quarter? How have earnings been and how are valuations stacking up? Nigel is here. Let's quickly go over the numbers and then we'll get you some industry voices as well. Nigel?
Well, in the past quarter, cement companies, they went for volumes rather than going for profitability. So the volume surged up, market share was maintained, but profitability did take a hit. Quarter four, though, is looking up. So there will be an improvement in quarter four in comparison to quarter three. Now, one place should come up for you. We saw volume surge by nearly around 10%. Realizations were higher as well, but cost went up. And that's why the EBITDA per ton did get dented. Now, we've seen cement companies underperform in the last few months, and valuation-wise, some of them are available at replacement cost. That's at $100 on a per-ton basis. Big names like ACC and Ambuja Cements as well have corrected big time, and premium names like an Ultratech Cement and Shree Cement as well. Valuation-wise, they've become a tad more attractive than what they did at the start of the result season. Very quickly, quarter four is looking better. Why? Because cement prices are up by nearly around 5% in the month of January. In February, in January, prices were rolled back. Input costs have come in lower, so that's what will help profitability going ahead. But very, very importantly, you need to keep an eye out on the trade segment and pricing out there, because infrastructure demand is good, but trade segment, that's going to be very, very crucial.
Okay, thank you very much, Nigel. Sorry, we are out of time and couldn't get a more detailed analysis from you. But importantly, volumes up, margins under pressure because costs were up. Shailendra Choksi, full-time director of JK Lakshmi Cement, and Sanjay Laddiwala with us. Good morning, gentlemen. Thank you very much for your time. Mr. Choksi, how are prices? Are you seeing that you are getting pricing pressure, pricing elbow room in any of the markets?
Well, we really actually can't complain about the pricing. The pricing have been not all that subdued. The only problem has been that it has not been able to keep pace with the type of cost increase that we have been seeing in last 1 year. Notably in the fuel and the logistic, all driven by the comparatively higher petroleum prices. Otherwise, the volumes have been good. The mood has been quite buoyant, and we have all the indicators which point out to a continued good growth in terms of volumes. So I think the one piece that one really needs to tackle is the pricing.
Oh, absolutely, sir. That's why the question, because volume growth has been no problem at all. On pricing, particularly for JK Lakshmi, what is the kind of price increase that you've taken, say, since the start of this year, since January onwards? And to what extent does it cover the cost inflation, or is there still a threat to margins?
Well, we haven't yet been able to really cover up our margins or the cost inflation that we have witnessed in none of our markets. You see, as far as taking the price up is concerned, I think it's a constant battle. What matters is whether the increased price remain on a sustainable note. We haven't yet witnessed that. And I think gradually, as we are moving towards a capacity utilization of about 80% or so in most of the markets, then I think the pricing power will get back. So I think give or take a quarter or two, I am very bullish that the pricing power should be back with the industry, which it hasn't had for a good 2 to 3 years in the past.
Okay. Mr. Choksi, isn't there a price, raw material price disinflation now? I mean, the raw material price was a problem of the third quarter. In the fourth quarter, it has softened, hasn't it?
Well, some of the costs have been subdued, I would say, notably that of the fuel.
Yeah.
But it hasn't gone down to the extent what rise we have seen. You see, we saw quarter on quarter in the Q3 a jump of about 12%. What we have witnessed in Q4, slightly getting reduced to about 2 to 3%, is still they are way up what the prices were, the costs were last year. The other is the inflation in the logistic cost. And cement, as you know, is a very highly logistic-driven industry. And the logistic cost, as the economy is moving, as the GDP is growing up, there is certainly much amount of traffic that one witnesses, and therefore the immediate, I don't see much of a trigger in the logistic cost coming down substantially. In our own case, we have been able to keep it at a fairly stable level based on our lead reduction, etc. But how long we'll be able to hold it is a question mark right now.
Okay. Mr. Ladiwala, good morning. What is your sense about pricing and capacity utilization? You know, today, for instance, and not just today, for the past several weeks, Ramco Cement has run up a great deal on expectations that they have got more pricing power, and especially pricing power in the south is rising. Can you give us an idea of where prices are increasing, and where are we in terms of capacity utilization for the industry?
Well, yes, you're right. The prices have gone up, particularly in the southern region. It was waiting to happen because they were affected by the northeast monsoon, and the prices were actually supposed to be going up by end Jan, which they didn't. And they have just started moving up in February. So I would see a rapid increase in prices and a constant and steady one there onwards, at least till the end of the peak period. Having said that, whenever this happens, there is less material flowing to the other regions.
Okay.
And therefore, that helps establishing higher prices in the other regions. So material which is flowing from the south to the west comes down because the prices are more lucrative in the south, and therefore the southern prices, the western prices go up, and so forth. It's a domino effect. So once the price rise starts, the prices will be much better going forward. That also, we have seen volumes going up, and therefore capacity utilization is creeping up. We are at 70+% for the whole industry, which is a very good sign. And now there is not much newer capacity being added. Classically, we've always seen that whenever there is lesser addition to capacity vis-a-vis the percentage in growth, there is always pricing power, and that is what is giving us pricing power. I dare say the average price for this year will be much higher compared to the last year.
So, Sanjay, if you could just help us with some numbers so we could put this in context. What is the quantum of the price hike that the South has seen? And since you're expecting this to spill over in other regions as well, what is the average increase one should expect? And where will it be the most, stark?
Okay. Firstly, it's difficult to quantify, generally speaking, because there are a lot of factors that go into every region, from the amount of capacity installed in that region to logistical costs and lots of them. However, by just rule of thumb, if you can say, 7% or thereabouts is the current increase in the southern region. West will follow suit by much lesser than that, I would say about 5%, and then will be the north. However, as we approach the peak of the current season, which is till mid-June, we should see a gradual increase by about another 5% or so. However, that's only a guesstimate, and I'm talking broadly across all regions.
Take your point, Sanjay. Actually, it's a very short time we have for an important conversation. Mr. Choksi, if you can leave us with what looks to you to be the outlook going forward. The positives appear to be the government's big push for housing and real estate. And on the other hand, the negatives appear to be problems in liquidity, problems in the NBFC and debt markets, and a general rural distress. How is the mix for the next, say, 6-8 months?
You see, apart from what Sanjay mentioned, I think this is a very important factor that the segment where we are witnessing a growth, in the first 6 months of the previous 12 months, the growth was mainly coming from the infrastructure, where the headroom for price increase was not much. In the last 6 months, we have seen a traction in the housing, and not just the housing for all scheme, which has been a great support, but you see the affordable housing and even the individual housing in the middle tier cities has suddenly we are seeing a traction. So I think that is an additional factor which will help us, the industry, for getting some pricing back. And I think that will supplement what Sanjay was just mentioning. Going forward, I think we are very confident that the volumes will continue, and therefore, based on a comparatively subdued capacity addition, the gap between the demand supply, which had risen to as high as 30-35%, is likely to get tapered down to about 20-25% type of a scenario. And therefore, all the portents are there for a reasonable price increase, so that the industry, which has not been able to make up for the cost push, should be able to compensate to some extent.
Okay, Mr. Choksi, we have to leave it at that.
Profitability, perhaps, as we go
Thank you
forward.
very much, Sanjay and Mr. Choksi, for joining us. That's a very optimistic call coming, and cement stocks doing very well today. We are wrapping up on Bazaar, trading ideas on Chartmaster.